Do you ever wonder if you should buy a stock? Is it the right time? Should you wait a little longer until the price goes down? Well, I'm going to show you how to value a company using a discounted cash flow model. And this is the best way to value a company. You figure out the intrinsic value. And then we're going to look at the ratios of the company and compare them to its competitors. So the company we're doing today is Power REIT. So let's get started with the model. First, we need the market cap. And that's the value of the company according to the stock market, $49.2 million. It's a really small company. So now we can figure out the shares outstanding because it's a market cap divided by stock price, 2 million shares outstanding. And we need a free cash flow because that's how you figure out the value of a company. You estimate the future free cash flows, then you discount those numbers back to today's value. And I'm going to show you the entire process in this video. Free cash flow is such an important number for a company. It shows how much cash is remaining after operating a business minus capital expenditures. But we also need net income. That's the profit and loss on the income statement. And we got to put 4 years of that into the model. And last is revenue. That's just the sales for this company. So that's 4 years of sales. And their sales are the lease and rent payments on the properties they own. So the way to value a company, you can't have negatives. If it's mostly negative free cash flow, negative net income, it would be really difficult, almost impossible to value. And you can't have numbers that are really volatile. So this looks fairly consistent, so I think we'll be able to get a value for the company. But we need to know the discount rate to apply to those cash flows. Let's get the interest expense. That's on the income statement, and that's how much interest this company pays on its debt. And they pay $500,000 on their debt. And let's see how much debt they have. We could just go into the balance sheet for that. We'll go into the liabilities section. And then the current debt is debt due within 12 months. And the long-term debt is debt due after 12 months. That's $24 million. So they pay 2.16% interest on the debt. That's a pretty good rate. And REITs do not pay taxes, so the cost of debt is 2.16%. Now we need to figure out the cost of equity, and we get the beta for that. And the beta is the volatility of the stock. And the more volatile a stock is, the higher the discount rate will be. That's a really low beta, 0.53. That means the stock moves about half of what the market moves. So let's get their current assets. And current assets are assets that can be liquidated into cash within 12 months. So it's mainly cash, accounts receivable, and inventory. And then let's get their current liabilities. Those are payables and debts that are due within 12 months. And that's usually current debt and accounts payable. We also need the equity. And equity is the value of the company according to the balance sheet. It's total assets minus total liabilities. And their equity value is $13 million. Let's get the EBIT. We'll go back to the income statement. That's earnings before interest and tax, or some people call it operating income. And that's how much money is left over after operating your business. And they have almost $2 million left over after operating their regular business, but that's before they pay their interest and taxes. Now we can see they have 65% debt in the capital structure. It's a bit high. The rest is equity, so the WACC is a blend of cost of equity and the cost of debt, and that's 3.64%. So that's what we're going to discount the future cash flows by. So we estimated the future free cash flows for 4 years, and then we did a terminal value, which is all years past year 4. We discounted those numbers back to today, and we get a value of the company of $49 million. And when we divide that by the shares outstanding, we get a stock price of $25.40. So it's trading almost exactly at intrinsic value. It's trading at $25.71, which is a 1% difference from what I calculated. Let's see what Simply Wall Street calculates their intrinsic value, $25.32. So we're all in the same ballpark. This is not too common that a stock trades at intrinsic value. And you could see it was trading at a really big discount for a long time. I wish I would have looked at this company a year or two ago, because I might have bought it. Because now they're finally trading closer to where they should be trading. But for a while, they were trading at a massive discount. But stocks can always trade at a premium or discount. It's just really based on supply and demand of the market. Let's look at the ratios of the company to get maybe more information. Wow, a 52 PE. That's a huge PE. I like to see under 15, but that indicates it's not a good value. And that's probably because the stock price has been driven up so much. If we looked at it a year ago, the PE would probably be really low, because PE is price over earnings per share. And when the price was really low, the PE was low. And the average PE in the stock market is 25, and the median PE is 16. And the price to sales, they have a really high price to sales also, 22.6. Their price to book isn't too bad, 3.8. That's stock price over book value per share. Really high current ratio. Their current assets are 18 times their current liabilities. That is just massive. Why do they have so much current assets? Let's look what their current assets are. It's all cash. I could sit on cash and get 1% interest at the bank, but I'm not taking the risk of investing in a REIT to get 1% return. So they should be using that cash for more lucrative things like buying properties. They have a low ROE, only 7%. Their interest coverage ratio, they cover their interest a little more than 3 times, so that's okay. Their debt is definitely on the higher side with 65%. And we've done 12 REITs since I started this channel. And this is all the REITs I've looked at. So I have all the information readily available. Power REIT has a really bad PE ratio, even compared to its competitors. There are some with worse PEs, but a lot have pretty good PEs, under 10. Price to sales ratio, they're definitely higher than average. Average is 7.1, they're at 22. And then the price to book, they're a little higher than average. Current ratio, they're just way highest, and that's not a good thing. They're just sitting on a lot of cash. Average REIT I looked at has 63% debt, so they're at around average. And their market cap is by far the smallest. This is one of the smallest tickers I've looked at since I started this channel. So they don't have great ratios just because their price has come up so much in the past year or so. But if the price comes down, it may be a good buy. But that's up to you. Let me know what you think in the comments. Thanks for watching the video.